Demand is everything, and this is how to spot when a suburb is going to pop. Demand metrics, the three keys that we want to look at: days on market, vacancy rate, vendor discounting. So days on market is how quick property sells. So if it sits on the market for 10 days and it's sold, that's super quick. So 30 to 60 days is a balanced market where buyers are evenly matched with sellers. 60 and above is where buyers are spoiled for choice. They can look at 10 properties on Saturday, go back to their favorite three the following Saturday, and maybe lowball all three and they might get one. Vendors are getting frustrated and pulling their property off the market from sale. 30 days and below is where buyers are competing, they're selling super quick, buyers are missing out, and buyer frustration's kicking in. It's important to look at the trend line of the days on market as well when analysing where it actually is. If it's 40 but it's trending lower, that could be a good sign, whereas if it's 40 and trending higher, it could be a bad sign. Vacancy rate, how many properties are vacant on the market at any one point in time. The lower the vacancy rate, the higher pressure there is on rent. The higher the pressure is on rent, more investors are going to want to buy in that area, creating more buying demand, driving prices higher. And finally, vendor discount. This is one of my favorites. If a property is listed for $500,000 and sells for $450,000, that's a 10% vendor discount from what the vendor got from what it was listed for. If it was sold for $495,000, that's a 1% vendor discount. And then once we start going to a positive or a premium, it sells for $505,000, that's a 1% premium. $550,000 is a 10% premium. So we want to watch the trend line of the vendor discount to identify or help us understand where that property is in its market growth cycle.